Welcome to the latest edition of Fundamentals, where I'm going to look at one of the 10 most popular tracker funds on the AJ Bell Youinvest platform right now, namely Vanguard FTSE Developed Europe ex-UK ETF. Now, the tracker product is an ETF or exchange traded fund. It's designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the tracker is following an index which covers Europe's stock markets excluding the United Kingdom. The benchmark consists of around 400 large and mid-cap companies. 2/3 of the assets are held in firms quoted within the Eurozone, and the other third is within firms outside the currency bloc. Oddly enough, the three biggest holdings are actually all Swiss: food giant Nestlé and pharmaceutical leaders Novartis and Roche, while other key positions include German electrical engineer Siemens, French oil major Total, and Belgian-listed brewer Anheuser-Busch InBev, which has just bought SAB Miller. The first graphic then shows the sector weightings. Financial services, healthcare and industrials predominate, while real estate, utilities and energy, well, they've got a relatively limited presence. Next up, we can see the country exposures. France, Germany, Switzerland, the Netherlands and Spain represent 3/4 of the assets under administration between them. The majority of investors looking at this tracker will probably be seeking capital gains, although the ETF offers a 12-month yield of around 2.6%, and any dividends are paid quarterly. So, those are the mechanics. The question to address is why your fellow investors are buying this tracker in such numbers right now. Well, we last looked at the tracker about 6 months ago, and this seems a pretty good time for an update for 3 particular reasons. First, there are signs that the Eurozone's economy is emerging from its trough of despond. Car sales rose 11% last year. Inflation is now 1.8%, only just shy of the European Central Bank's 2% target. And all Eurozone members now have got inflation in positive territory for the first time in several years. Regular viewers will also now know that our preferred European indicator is Belgium's Courbe Synthétique, and that's showing improvement too. Now, quite right, an industrial sentiment indicator that uses the views of 6,000 Belgian industrialists is such a keen insight into Europe's fate overall, well, that's another matter. But it does seem to work, even allowing for the fact the past's no guarantee for the future. But the upward trend seems to be intact, and where the Courbe goes, European stocks have tended to follow. Second, the European Central Bank continues to do whatever it takes to keep the show on the road, with record low interest rates and its quantitative easing programme, which is 60 billion euros a month and is scheduled to run until December. And the third reason investors may be looking at this ETF right now, well, markets like to climb a wall of worry, and there's no shortage of things to worry about, especially as the imminent Dutch and French elections could in theory empower politicians who are anti-euro, and thus raise fresh existential questions about the single currency. More tangibly, what all of these concerns mean is that the FTSE Developed Europe ex-UK index is still below where it was a decade ago before the financial crisis broke. That's a contrast to the US and UK, which trade at or near new highs, and that may be persuading some of your fellow investors to think that Europe maybe offers a little bit of value. Now, none of that's to say Vanguard FTSE Developed Europe ex-UK ETF comes without risks. This final chart shows the tracker's price development since it began trading in September 2014, and as we can clearly see, it goes down as well as up sometimes. There is clear scope for further political and economic uncertainty in the coming months, especially as those key elections take place and the UK inches towards invoking Article 50. Meanwhile, the latest Greek debt repayment deadline is July, and that's a further pressure point. The European Banks Index has wobbled in the last week or two, and Athens' debt problems could spark fresh worries about the overall health of the Eurozone economy and especially that of its lenders. Markets will also be keeping an eye on the European Central Bank. President Mario Draghi has already trimmed the monthly amount of QE from 80 to 60 billion euros a month, and any signs of further reductions, or that the programme may not be extended beyond December, could provoke a taper tantrum if the experiences of America in 2013 and 2014 are any guide. Thank you for watching, and I look forward to seeing you next time.